What's the safest way to lose money in investing? It's to buy the thing everybody is talking about. Because this is how those waves form, right? There are the early adopters, there's the smart money, there's the money that can, to a degree, foresee where things might be trending. And then at some point, a trend gets established, right? More and more people adopt something. And as more and more people adopt something, there's more and more talk about this, because in line with more attention comes also price appreciation. At some point, though, the market is somewhat saturated, right? There isn't enough new people coming in to push a price further up. Thus, if there is peak attention on something, then there's also a peak price usually. And that is a bit of a problem, because in every other area of life, it doesn't make sense to simply just follow the masses, right? It makes sense to follow the rules, to do the things everybody else is doing, right? When everybody is driving on the left side of the road, it probably makes sense to also drive on the left side of the road. If everybody thinks that this particular university is very good, then this becomes a self-fulfilling prophecy. Then probably the best professors indeed want to join that university. Then probably you should be studying there. So very often there are trends, and following those masses makes a lot of sense. But unfortunately, in investing, I believe very often that's not true. You do not want to get into something when everybody else is talking about it. You rather want to think about selling at that point in time, right? When you look, for example, at Super Bowl ads, right? When the Super Bowl has the advertising, it's very expensive advertising space. When during those kinds of advertisements, we suddenly see an investment being advertised, then it's probably not a great idea to get in, right? When there was all this advertising around .com companies during the 2000s, it was the worst time to buy internet stock. Or if there was, say, all this advertising around buying houses, right, with 0% down, or maybe even with 100% loan to value ratio, and that was then advertised during the Super Bowl, it was also the worst time, because then subsequently came the property crisis and the global financial crisis, right? Or once we saw FTX advertising, and once we had our FTX arena, etc. Once investments become super mainstream, it probably makes sense to exit. Because again, we see those waves. And very often when everybody's talking about this, there isn't that much further growth anymore. And everybody that onboards at that point in time becomes the exit liquidity for the people that bought in early. And so I believe most money is probably made during those reflection points, during those turnaround points. So you want to be right when the masses are wrong. And that's not necessarily very easy, right? Because markets tend to be somewhat efficient. There are these massive ups and downs, but very often the market does price attention relatively well. And so there are two kinds of reflection points, or two kinds of opportunities where you could potentially make money. The first one is simply just when we are overheated, right? When everybody talks about something, and that's when you want to exit. Now, the nice thing about crypto is we've got on-chain metrics. We can look at, for example, what our long-term holders doing, right? Our long-term holders selling. When they are selling, then I tend to sell as well. I talk about these kind of metrics several times on this channel, so feel free to check out other videos. So these turnaround points are very useful. The hype is normally relatively easy to identify, because at that point in time, we do see the Super Bowl ads, etc. The reflection point at the depressed prices isn't that easy to identify, because unfortunately, we can be at depressed prices for a very long period of time. Now, with crypto, everything is accelerated. And so even if we buy it during a depressed period and we stay low for another year or two, it doesn't really matter. But when we get into the traditional markets, it's a bit different. For example, let's say you bought gold at the beginning of the 1990s. And you bought this as a contrarian bet, because during the 1980s, we've already seen how stocks, and especially tech stocks, performed very, very well. And gold, relatively speaking, underperformed quite a bit. Let's say you bought at the beginning of the 1990s. You still had another 10 years of underperformance for gold. And gold underperformed stocks at that point in time by roughly 90%. So finding the turnaround is actually the real art. And finding the turnaround when things are depressed is even harder.
Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com.
Imagine how hard it must have been to dollar cost average into gold during the 1990s. It must have felt like you're always burning money, right? You're throwing money at something that doesn't appreciate, while you see all of those stocks going higher and higher. And then in the dot-com bubble, we've seen stocks going up by 30-40% on a single day. Imagine you were the one that's not getting into that hype, that's buying gold at the time. It's a super hard purchase, right? It's painful to do those kinds of purchases, but those are the ones that then in the end pay off, right? If you bought gold in the year 2000 and you did that instead of buying into the dot-com hype, you would have outperformed even the S&P 500 by 10x in the subsequent 10 years. So it's really about figuring out where currently the mass psychology is moving. What are people really craving for? Do people want to get performance? Do they want to get risk exposure? Or are people rather scared and want to get something safe? For example, when Nixon announced that you couldn't convert your US dollars anymore directly with gold, when there was not the one-on-one link anymore, that was the point in time where gold outperformed everything else, including stocks. Only once the tech boom started in the 1980s, only then were stocks attractive again. Only then gold, relatively speaking, underperformed again. So catching the narrative of the day, catching the zeitgeist early is probably the best way to buy the bottoms. It probably makes sense to try to figure out what are people really concerned with. Right now, it appears, at least on the face of it, that the financial system is still somewhat stable, right? But once we see the first bailouts again, maybe at that point in time, gold and silver might go up again. Right now, it appears that people are still mainly looking for returns, not necessarily for stability. And one reason for this could be that everything gets more and more expensive, right? And you need to have more returns in order to simply just keep up. But once fear takes over again, this can flip very, very quickly. I believe that the long-term capital concentration, right? More and more money is in fewer and fewer hands. The long-term capital concentration is probably the reason why across generations we see more and more risk-taking. So let's say 60 years ago, it was very common to just buy a house with not too much leverage, to also have maybe 40% of your money in bonds, and to have maybe 60% of your money in stocks. Then in the subsequent generation, 30 years ago, it wasn't that common anymore to have that many bonds. And it was also pretty common to have now houses with a mortgage. So you increase your risk, you don't buy any bonds anymore, you mainly have stocks, and you lever up your property. Nowadays, in the current generation, nobody wants to hear about bonds. Most people don't even want to hear about Coca-Cola or Disney stock. Most people want to buy only technology stocks and crypto. And why is that? Because it's harder and harder to keep up. And the reason why it gets harder and harder is again because of capital concentration, right? Labor becomes cheaper and cheaper relative to capital. Most returns are generated by the people that have capital, or at least that have access to cheap debt that can then devalue over time as the monetary base expands. And so maybe at some point in time, we will see a new asset class evolving, something beyond crypto, something that's even more risky than, say, Bitcoin. Because, of course, altcoins are more risky than Bitcoin, but altcoins are also very speculative in the nature of you can't necessarily save in them, right? You can't buy an altcoin and hold it over the next 20 years. You're very likely going to lose money with that. So you can't really use it as a savings vehicle, similar to, say, a stock ETF or similar to, say, Bitcoin. But maybe at some point in time, right, the return for Bitcoin isn't high enough, and the new generation will come up with something that's more risk on. And at that point in time, we have to be open-minded enough to buy that new thing, whatever that will be. Most of crypto gains had been made by people in their 20s and in their 30s. I believe a lot of the next asset classes returns will again go to the younger generation. And so I believe it's all about adopting things very early and do the exact opposite of what the masses are doing. You do not want to buy when everybody talks about something. You want to buy something when nobody talks about it. And ideally, you want to buy something that nobody knows about yet. So not necessarily an asset that's simply just depressed and that already had its hype. Ideally, it's something that nobody knows of yet. Returns are made when something isn't yet proven. Returns are made when there's still a lot of potential growth ahead because the world doesn't know about it yet. If you want to support this channel, feel free to give this a like. It helps the channel grow. Feel free to also subscribe in case it's your very first time here. And in case you've got Telegram, you can also join us over there. The link is down below. Looking forward to chatting with you. Cheers.